Okay, guys, let's get going. Let's start with our disclaimer. This presentation or webinar is provided solely as a courtesy to aid the education of our customers and prospective customers. It will discuss risk management concept strategies and does not include the recommendation or endorsement of any particular security, chart pattern, or investment strategy by forex.com. This presentation has been prepared without regard to the specific investment objectives, financial situation, and needs of any particular recipient, and we don't guarantee or verify the accuracy of the information or commentary provided. Futures, options on futures, foreign exchange, and other leveraged products, they involve substantial risk of loss and are not suitable for all investors. Spot gold and silver contracts are not subject to regulation under the US Commodities Exchange Act, and contracts for difference or CFDs are not available for US residents. Okay, guys, I know that this has been pushed to a different time than normal, but normally it will be 11 o'clock on Tuesdays from next week. So do bear with us this time, and I know probably some of the regulars might not be able to have attended today. They might have been expecting yesterday. Apologies for that mix-up, but anyway, we'll try and do our best here. Let's start with Euro, because we've had an interesting day, right? If I actually go onto an intraday chart, this might even be better, because it will tell the story, basically. Actually, I'm going to go back to 2 days. Inflation, those of you who were following the macro side of what's going on in the Eurozone, inflation is really, really critical part of the ECB's next decision, or part of the ECB's policy-making decision, of course, because it's their only mandate. What we saw was some German inflation come out yesterday. Can you guess when, maybe? What about here? German inflation came out yesterday, and it was weaker than expected. Inflation in the Eurozone has been very, very weak. It's 0.5% in March. Well, it was the April data that we were looking at. The April data did rise, but when this German data came out at 1 o'clock, actually, so spot on 1 o'clock, we saw the euro start to fall, and it backed off from that 138.50 highs, pushed all the way down to a low of the last 2 days of 137.75. That's major support right now. As you can see, we dawdled lower into the end of Tuesday's session, and then again came in and we sold off again today, and that was before the overall Eurozone figure. So in the Eurozone, what you get is basically countries like Germany, like France, they release certain data releases before the overall Eurozone figure. So because Germany makes up about 30% of the overall Eurozone CPI basket, if you like, or data pie chart, how probably not a great way of explaining it. But because they make up 30% of overall Eurozone inflation, what goes on there matters. So the market saw that there was weak news out of Germany, thought, hey, that's going to be a big deal, let's sell the euro now. What we saw then was that continual selling until we got to this point, 10 o'clock. The Eurozone released its overall inflation reading for April, or its flash inflation reading for April, I should say. And it was 0.7%. The market had looked 0.8%, but hey, even with weaker inflation, we moved higher. We're back comfortably above 138. So what's going on here now? What's the, why has this happened? Why is the market reacting as one wouldn't expect? Well, I'd say there's two reasons. Number one, there was a lot of expectation about Germany, because Germany saw slightly weaker inflation. Hence, there was, a lot of that bad news, if we like, bad inflation news was already priced in. Secondly, even though inflation was weaker than expected, it came in at 0.7%, which is up from 0.5% in March. For us, that 0.5% level is quite important. It's a bit of a Rubicon, or it's a line in the sand, that if we were to get another 0.5% reading, maybe even a sub 0.5% reading, I think that would have probably made the ECB take some action. Make the ECB take some action. I think at the moment that's not the case. So Alexander, you're saying is the euros, let me just pull up a slightly longer term chart. I think there's a couple of reasons for the euro's resilience. I think number one, from a market perspective, it's because the dollar isn't able to rally, which I'll talk about in a moment. I think number two is that the fundamentals at the moment are quite supportive of the euro. Growth is still fairly strong, and it doesn't look like the ECB is going to take any action anytime soon. And then, of course, you've also got some technical ones. I was talking to another colleague recently, and he said he found an interesting, or told me an interesting statistic, which was basically with the euro dollar, when the euro dollar is going up, so as it has been really since say June, or the July lows from last year when we were sub 128, it's been on very low volume. What you tend to see is a volume in euro dollar really shoots higher as when it's coming down. So you get a lot of volume, a lot of people interested in selling the euro, not that many people interested in buying it, which suggests that it's all kind of trend related. They don't really want to buy it. But there's nothing standing in the way to stop it from falling. They're not willing to stand in its way either. That's possibly because the euro as a currency, euro as a political concept, euro as a monetary union is a very complicated beast. That could certainly be one of the reasons. But as you can see, there is a lovely trend line. Let me just draw that for you, which is cushioning the downside. It coincides as well. Oh, sorry. It coincides as well with obviously that cluster of moving averages too, as one would expect really, but it is significant obviously, and it's certainly helped keep euro up. I think partly obviously this the technicals do matter, the technicals do come into play, and the fact that we did actually bounce down to that kind of 37.60 level was important. Another key support level though that a lot of people in the market are looking at, so obviously in the next few days, as I said, half the reason why the euro has been rallying is because of the dollar, right? The dollar has been very, very weak. However, there is some important data coming out of the eurozone today. We get ADP, so a pre kind of little taster, an amuse-bouche if you like, before the NFP on Friday. We then get, of course, GDP later this afternoon as well. And then, of course, the FOMC meeting. And I'll talk more about that in a moment. But if that turns out to be some dollar positive news, I would watch out for a couple of levels. Obviously, that trend level is very, very important. However, with trend levels, sometimes you can flip them and still actually be in an uptrend. For me, the 136.64 level is going to be really critical. That's the 61.8% retracement of the February to March advance. I think if we were to get down there at any point over the next kind of 24, 48 hours, it could spell game over for the Eurozone and would really just kind of reinforce the fact that maybe the market is now willing to sell the euro at long last. So that's something to watch out for there. Pan, you're talking about dollar and CAD. So the dollar against the commodity currencies, maybe. Before we do that, let's take a look. I know my colleague Fawad put a great piece out on oil earlier, so please do look at that on our website. Let's take a quick look at oil actually. At Brent, obviously there's been some kind of interesting developments, what with various kind of fundamental supply issues, and we also have thank you for that, Maverick. I do have a bit of a cold, so you're going to have to bear with me. And also, obviously there's the commodity markets are going to be impacted as well by what's going on in the US, data-wise and FOMC-wise. But as you can see, we're really stuck right now in between this cluster of moving averages in oil. So oil is it's backed off its highs and it's now trading sideways. That's the kind of thing I want to keep you in your mind. Let's take a quick look at Aussie, or the US dollar versus the Aussie. Let's start with that one, Pan. And as you can see, it doesn't look too dissimilar, right? We've backed away. Yes, last week, obviously, it was a CPI release from the Eurozone a couple of weeks ago, or from the Australia, a couple of weeks ago, that really triggered the first stage of the sell-off, if you like. Really made 95 a bit of an unsurpassable barrier, and we backed off quite sharply from there, and we've continued to really. But as you can see, the range has been quite narrow. In fact, I'd argue that the range in Aussie dollar has been very, very narrow since February. So the beginning of February, that was when the RBA dropped its negative bias or dovish bias, if you like, and moved to a neutral stance. That caused a big wave of enthusiasm for the Aussie. And we've had some other kind of dots of waves of enthusiasm for the Aussie. But overall, on the downside, we've seen quite shallow moves lower. And that just suggests to me that maybe we're just, a bit of profit taking place. Doesn't necessarily mean that the uptrend is over. But we are getting a little bit worried right now, that maybe it's just on pause for a slightly longer, more protracted period. And again, as I said, if we just look at the lows, say from the year so far in January up to the highs, we haven't yet pulled back in any meaningful way. 91.65 is 38.2% retracement of this year's up move, or the January to April up move. If we were to get back there, then that could act as very good support. If it gets below there, that would be very negative. That also coincides really with that kind of 50 and 100 and 200 day moving average. But overall, this is just looks like a pullback at the moment. But the data this week is going to be very important, because obviously it's been a bit more, maybe a bit more aggressive or a bit more sustained pullback than some people would have liked. So that means that we do have to kind of, certainly watch out for it. Dollar CAD as well. So the trouble is, leading up to these FOMC meetings, you do tend to see, a lot of range trading activity. As you can see yesterday, though, with dollar CAD, we had got, well above 110. Had a nice recovery since this low here. When did that happen? That happened on the 9th of April. Had a nice recovery. Couldn't get above the 50-day moving average, though, which came in at 110.55. I think that's quite telling. We saw a big, strong reversal yesterday. That was really on the back of, overall, dollar malaise. There was a lot of people, going long the dollar against other currencies. So, for example, the euro and the pound, and that had kind of an impact overall. We've also, this cross was also obviously impacted by domestic fundamentals. And on that note, we do have both countries actually releasing GDP data this week, or today, sorry, I should say, at the same time at 1:30 London time. So it is really worth watching out for that one quite sharply. But as I said, there wasn't really anything, this move here, this very large negative candle, as you can see, it had no wicks. That's quite interesting. It suggests that the market was just in a block pushing it lower, that there weren't any kind of extremes, that, people were, just willing to sell it. There wasn't too much, it was relentless, basically. One of those candles are. But as you can see here, we're now climbing back to the 100-day moving average, which comes in around about 109.65. We haven't been able to get through there. A break below 109.45, which was the low from yesterday, would be quite a bearish development, obviously. I could see us back to these lows from April, maybe even back to the 108 level. But as I said, leading up to the data today, the FOMC meeting, and then of course we've got the all-important payrolls on Friday. That will be very important, and that's probably going to keep us quite range bound, certainly in the next few hours anyway, for CAD. Obviously, do watch that GDP data at 1:30. What you do sometimes see is when they release the same release at the same time. That's Canada and US, by the way. You can sometimes see some some volatility in this crop. So do watch out for that. But right now it seems to be like 109.50 on the downside, 110.50 on the upside. That's the range that we're in. It looks all a bit uninspiring, I think, for dollar CAD. And I think that's largely because the actual action has really been in cable. It's been in euro, certainly in the very short term anyway. And what we've seen is just, a little bit of weakening in these commodity currencies. I think if you trade stocks, it's worth watching it. Now, there haven't been too many unifying themes across markets of late. But what you used to see anyway is that, say, the risky end of the FX market, the commodity crosses, the Aussie, for example, that could move in line with stock markets. And that's obviously broken, but it still is considered a bit of a risky end. And if we, continue to see, maybe see some more downside in the Aussie, just watch what overall risk sentiment is doing. That would be my my advice. But yes, pound, unfortunately, it is very confusing at the moment. Prices are being annoying, to say the least. I'm sure there's plenty of other words you can use, but we've seen that really since the start of the year. And I think from an FX perspective, I think we need hard data. I don't necessarily, I'm just writing a piece now, and I don't really think the FOMC meeting this evening. It doesn't have a press conference anyway. But even if it did, I don't think it would be that useful for anybody, because I think, you know, the FOMC at the end of the day, they're sticking to their tapering plan. They're unlikely to change anything. And that, to me, means that the dollar's going to stay weak and 10-year bond yields. Let me just put up 10-year bond yields. Because essentially what we're saying, what you're saying, Japan, is by looking at kind of maybe the US dollar against these commodity currencies, is that you're, you know, you're confused, right? And it's largely because of the dollar move. And I think that's, you know, this is the root of all confusion, is because the dollar is not rallying. It's being really annoying. It's not really trending. So instead you're seeing these very annoying kind of drawn out trend patterns. One thing I would say is that when you see drawn out trend patterns, they're not necessarily, or drawn out range trading periods of range, sorry, not trends, then what you do tend to see is they don't tend to persist for that long. And I'll show you another chart in a moment, but let's just look at these 10-year yields. As you can see, very, very similar. I mean, look at that. When was the last time we saw yields move sideways? Well, for that period of time, not for a very long time, for a little bit in October, November, but really since February, for most of this year. And that is why you can blame confusing markets, markets that are reversing on seemingly to be nothing, and their inability to trend. Blame it on this yield. If we go back a little bit, even if we go back 5 years, I think we'll have to go back a long time. Let's go back to the max. You know, obviously it doesn't look too much there, but, you know, as you can see, we're often kind of in an uptrend, downtrend, uptrend, downtrend. Of course, there's many trends in that. But I think over the last year has been really something special. Certainly since the beginning of this year has been something special, in the sense that in terms of the range that we traded in, it's been so narrow. You know, if I just go down, say 6 months, even if I go down 5 months, the range has been so narrow since February, really, with the low being 256.80 and the high being 281.88. That's 30 pips. So what can you read from my 10-year yield chart is that basically the 10-year yield is an important driver of the dollar, I believe, and it's, you know, the 10-year yield is driven by the Fed. So if the Fed drives the 10-year yield and the 10-year yield is one of the drivers for the dollar, then you can blame the Fed for its lack of movement. It basically suggests that the dollar isn't necessarily going to move anywhere fast. That's what I would say from for what this chart is indicating to me, is that it's not going to move anywhere fast. That, you know, if bond investors are sitting on the sidelines because the FOMC is confusing, then, you know, you can bet your life some FX people are as well. So until we break out this range in bond yields, we may not break out, we may not be able to see the dollar rally. Let me bring up the dollar index. The dollar against its biggest trading partners. It's a good broad base of looking at what the dollar's doing against the G10. As you can see, it's weak, right? Particularly very weak against things like the euro, against the pound of late. But as you can see here, it's not really doing anything. That's also stuck in a very tight range. As I said, like, you know, we got to get above here. We've got to get above the highest level since February, which comes in around about 80.54. That's the 200-day moving average, to make anybody infused by the dollar, because I think a lot of people are. On that note, I know that Kusal is looking for cable. Let's talk about that. Obviously, yesterday in the UK, we got some GDP data. It's slightly weaker than expected. Go tell that to the FX market. It didn't really knock any spots off. Cable instead moving nicely higher, as you can see here. Like, you know, where are we going to go? I did send out a piece earlier this week, just saying his 170 on the cards in the very short term, and I thought kind of it would be, but obviously if we got a better than expected number, but obviously with the number being, you know, where it is, then potentially we're just kind of stuck just a little bit. Now I do want to just show you something. There is a little bit of there is quite a lot of resistance really on the way up. You've got the 100-day moving average, 100-month, sorry, moving average coming in at 169.78, currently trading at 168.20. We look fairly good, but that is a significant level. 170 has thwarted us before, back in 2009, and we haven't been able to get above it since kind of 2008, really. So 170 is, you know, it's going to be a big level. Also, if I look at an Ichimoku daily Ichimoku, or Ichimoku cloud, sorry, a monthly one. It's not very popular, the monthly Ichimoku, I know, and some people will say like, oh, you data mining, but I do think when you get to these multi-year highs, you do have to stretch your time zones, your time frames a little bit. So as you can see, Naeem, no, these charts are not forex.com charts. These are Bloomberg charts, a good thing to point out. Also, as you can see, the top of the daily itch making of the monthly itch making cloud, my apologies, comes in at 170.91 as well. So that's all quite important. But as you can see here, the momentum certainly in the pound anyway seems, like it's still going. I mean, that looks, like a beautiful trend, really. Let me pull up my other charts very quickly and we'll just take a look. These are my Bloomberg ones, as I'm sure some of you can tell. Some of you will have seen them before. I'll just bring up this one because Bloomberg do fantastic charts, I think, but they don't do great indicators and oscillators and stuff. So I'll just show you a bit of what's going on there. Now that's just euro that I was looking at yesterday, actually, using the same bib retracement that I showed you earlier. This is, why is this gone funny? Let me just bring my charts together. As you can see here, this is basically after being on a nice move higher, it's kind of flatlining. The oscillators certainly suggest that. I mean, it's still above the zero line, so that, in terms of the MACD, above the zero line, that can be considered bullish. Again, likewise with the RSI, it looks like we've just backed away from those highs around about 168.5, because we were starting to look a bit overbought, as you can see, getting very close to 70 in the daily RSI. So, kind of a period of sideways movement, especially leading up to such important data, is typical, I would say. So watch out for that one. Now, the other thing I want to show you, of course, is dollar yen. I know some of you want to trade that. So we had such a data dump this week. We've had the BOJ this morning, and then of course we get the FOMC later. The BOJ made no change. Again, that had been expected. No change from them. They sounded fairly neutral, to be honest. Kuroda did say that he would, if the need arose, he would add more stimulus. He also said that exit is too early to talk about exit. All of that good stuff, which helped the Nikkei eke out the tiniest of gains. But basically, if we see the economy fall off the cliff on the back of weak Japanese economic data, that could be good news, very good news for the Nikkei, and that's good news for the yen, because I want to show you another chart here. I'm just going to build it very quick.
2015 forecast at 1.8% growth rate.
Okay, here we go. This is the Nikkei and dollar yen. The Nikkei is in the paler. The Nikkei, sorry, is the brighter line, so the brighter yellow line. Sorry, it's not that clear. But as you can see here, they're kind of moving in lockstep. They've diverged a little bit, though, with the dollar moving higher as the Nikkei has come off. We think that's just temporary, and that they'll continue moving, lockstep, because largely, if the Nikkei does move higher, we think it's going to be caused by, maybe the Bank of Japan embarking on more stimulus. So that's kind of, worth pointing out there. Obviously, the divergence, though, is worth noting. Usually when things diverge, they come back together. But basically, looking at dollar yen here, as you can see, again, trapped in a bit of a tight range, hasn't been going anywhere for very long. It's desperate in need of direction. But as I said, will we have to wait for direction from the US side? I mean, the Bank of Japan, they didn't do anything. They certainly didn't do anything today to make the yen weaken. Whether or not we see dollar yen move higher or lower, or the next move, will be very dependent on the US side of things. What the FOMC say in their statement tonight. Remember, there's no press conference, and also, of course, what the
okay, you get a level on it.
Also what the economic data says, and the most important, of course, being payrolls Friday. But we do get ADP later today as well. Meta, I'm talking about gold. Okay, cool. I'll talk about gold. Obviously, we produce a lot of research on gold. Please check out our website. My colleague does that. But gold, as you can see, not really. Oh, sorry, it's not gold. Doesn't look dissimilar to the gold chart, though. Not really going anywhere fast. It's back below 1300. Doesn't look fantastic, I have to say. We've not really been able to replicate that kind of push higher from the beginning of the year. Instead, we're just kind of moving sideways, looking a bit lost. The downside seems to be capped at 1282, with the very short term, the upside being 1300 or 1299.92. which is the 200-day moving average. Above there opens the way to 13.18, and then potentially this kind of double top here at 13.33. Looking at it, just trying to get this out a bit. From the December low to the March high, there's some key support 1289.50, so just below where we are now, 50% retracement of that December to March uptrend. And then we also get, you know, obviously 1265 then is another key level, which corresponds with a bit of a sticky patch between January and February. On the upside, as I said, obviously you're looking at the 50-day moving average of the pink line in this chart, and then those highs that come in around about 1335 from April. So my view on gold's not particularly fantastic. I don't really see it going anywhere fast. I mean, there's no surprise to me that the last 24 hours gold has come under a little bit of pressure. Remember, it is considered by some to be an inflation hedge, so signs that inflation is quite weak in the Eurozone should be quite negative for gold. Someone's also asked me about Euro medium-term views on Euro. Let's just go back to this Euro chart. Those of you who join me quite a lot will know that I do like to look at clouds just every so often. I don't think they're that necessary, as you can see. I don't think they're like, you know, the be all and end all, but they're one of the tools I like to use just to get a grip of where we're going. The fact that we're testing around about that top of the cloud, we've dipped in, we've gone back above it. That's actually the again, same, pretty much it's the same. But as you can see, the fact that we're hovering around the top of that daily cloud suggests a reluctance maybe to push it one way or the other. It does suggest that maybe the uptrend is over. But whether or not we see the downside, as I said, it's all dependent on the US. And it's going to be all dependent on the data. Basically, with Ichimoku, when you fall back into the cloud, it suggests a technical end to the uptrend. It means that you could be in a period of moving sideways. You know, we've had periods of moving sideways for a while, being kind of, you know, tight ranges anyway, even in uptrend, even in trends. But this kind of period, January, February, really, we were very trendless and stuck in the cloud. So we're going to hope that there will be some trends that make trading interesting. Again, as I said, like, you know, so just going back to that point, then I would say that I'm reluctant to commit to a view about the euro right now, but if I had to, I would say that, you know, potentially the bulls need to time themselves, or the bears, sorry, need to time themselves correctly. But I do think that maybe steam has run out. I also think 140 is a bit of a line in the sand for the ECB, and if we get back there, then all of a sudden their rhetoric ticks up, and that causes a whole other load of problems. And then the bias comes to the downside. But as I said, 136.64, that was the fib level that I mentioned to you earlier on. And then of course the lows from April, they come in around about that 136.64 to 70 level. That's a really key support level. So I think it's going to be, you know, determined basically by whatever happens with US data, particularly payrolls. That to me is the most important. I'm happy to take one more question, guys. I know we're coming to the end of our session. Oh, Ray, thanks for that. So you went to an investment show in Islington on Saturday. Well, I hope you enjoyed it. You saw my book there. Oh, thanks very much. Yes, I did. I wrote a book. It's one of the favourite books on the FX Street website. So you can check it all out. It's called Kathleen Brooks on Forex, very unimaginatively. But yes, I'm glad that it was sold. Hopefully, it sold lots of copies. Helps my publisher to get rich, not me, guys. So guys, anyway, yeah, it's an educational book. My take on the FX market, which is slightly different. You might find it a bit quirky, might not be for everybody, but I hope some people do like it. So please do take a look. You can get it on Amazon as well. You can get it on Harriman House, they were the publishers. And again, like a lot of trade shows, they sell it. So please do read it if you get a chance, and let me know your feedback. I'd be always be interested. And also let me know any themes of books that you think should be written on the market. You know, I'm always on the lookout for another good look. Some people have been asking me what is the name of the book. Just bear with me one moment, guys, and I will pull up a link for you. So here we go, guys. The one thing I would say, mine is quite brief. and it's you know, it's just a different way of looking at the markets. It may not be for everybody, but hopefully it will be some of you. And also, yeah, let me know your thoughts. It's only 140 pages. It's very easy read, but I think, you know, life's complicated enough as it is. It's got 4.2 out of 5 stars as well. So do write a review if you like it. I think some people have thought it's a bit too, one person thought it was a bit too short, but I think that's kind of the interest. There's a lot of long things to read in life. Okay, guys, that's the book. Thanks so much, everybody, for joining. It's good for a newcomer. You know, that my book is really for a newcomer to trading, to just get a good idea about the markets, about how they work, and everything else. Thanks, FX Street, for rearranging this at short notice. And I'll be back next Tuesday at 11 as normal. 11 London time, by the way. I should clarify that. Thank you, everybody. Bye bye.